Welcome to Warwick Business School's Core Insights podcast on fintech. This is the seventh in a series of podcasts on fintech brought to you by the school's Gillmore Centre for Financial Technology. In this particular series of the Core Insights podcast, we're working with the centre's world-class researchers and professors, and alongside some really exciting guests from the fintech industry, as we explore the big issues around technology and the finance as disrupted or attempted to be disrupted by exciting new technologies. I'm Natasha de Terran. I'm your host, a former financial journalist and the author of The Payoff, How Changing the Way We Pay Changes Everything. And my job is a small one, is to ask the questions to find out just where fintech is heading. Today, we've got a really big question. Questions inside the question. The question is, will CBDCs bring about the end of Bitcoin and cryptocurrencies? Fortunately, I've got some really good guests to give me an answer to this question, and I am going to hold them to task. Firstly, I'm joined by David Skeie, the Professor of Finance and a member of the Gillmore Centre for Financial Technology. And secondly, I'm joined by Rhomaios Ram, who's the CEO of Fnality International. Before asking the question or beginning to try and ask the question, I just want Ram, because David, your role is pretty self-explanatory. You look at finance. You're also an advisor to the Bank of England and the Bank of England's academic forum looking at CBDCs. So you're sort of what you say on the page, but Fnality the name doesn't tell us so much. So, Ron, would you just tell us what Fnality's doing?
Yes. So, luckily, we're only to do with payments, so that should be relatively easy to frame. So, Fnality is basically creating a private sector answer to central bank digital currency. So, we're creating a regulated payment system held to the highest regulatory standards. Our settlement asset will have the same credit quality as central bank money. The reason for the name Fnality is actually contractually, we will be able to confer settlement finality, which means that your obligations will be discharged when people make payments. So you make a payment and that's it. You're kind of done on the transaction. We're basically aiming to do this in multiple jurisdictions. We're starting off in the UK, and our regulator is the Bank of England, and then we'll move to the US and the EU, and thereafter into other currencies.
Fundamentally, what you're doing is providing a private central bank money, a private
Correct.
Digital currency backed by fiat. So that presupposes that you think that we need some form of digital form of money.
So the genesis of this is actually, so what I'm working on is actually a wholesale, effectively a wholesale solution for central bank digital currency.
And by wholesale, you mean for market participants, for big banks to use amongst themselves?
Yes, basically for banks to use amongst themselves, banks and FMIs to use amongst themselves. And the reason that this is required, the banks for a number of years now have been looking at the DeFi space and observed that there are many gains, some of which are operational, but many of which are balance sheet related. If they adopted some of the techniques that have become visible in the DeFi space, in order to gain the full benefit of that, it's insufficient to start settling securities, bonds, trade finance, whatever, on blockchain. You also need to settle the cash leg on blockchain. And what we are doing is basically the solution to what is the solution for the cash leg on chain?
And the solution for the cash leg on chain is Fnality.
Fnality. Yes.
David, would you agree with the premise that Ram has just put forward, that you can't have digital assets on the one hand settling in non-digital, if you will, digital money, central bank money?
Oh, for the most part, yes, that's correct. And I mean, it's definitely much more efficient and and always better to if you can use digital money. I mean, what I'd say is the current system we have, you have digital money in terms of bank deposits, bank payment systems. In a sense, everything's digital. Lowercase digital money, but it's not the type of digital money that we're talking about with new technologies such that could be CBDC or synthetic CBDCs or other sources, stablecoin sources of what we're thinking as fintech digital money.
But we do at the moment have PVP and PVP and so on and so forth in the securities markets. So why couldn't we achieve the same thing in the digital space?
The simple answer is, of course, we have all of those things in the existing world, and in fact, the financial system that we have now is actually pretty safe and does things pretty well. It all works, if you want to use that. What is the cost of it all working in a safe way? And in order for it to work, one of the main issues is that you have different venues that you need to send your money to in order to settle your different transactions. So if you want to settle bonds, you've got to send them to, whichever clearinghouse deals with bonds. If you want to settle equities, it goes to equity foreign exchange, it goes yet somewhere else, and etc. And even within those things, it's not always the same venue. So what that results in, now I'm talking from the perspective of big financial institutions rather than anything to do with retail. What that results in is a kind of a split of your liquidity pool, number one. Number two, you're using these intermediaries as kind of stores of value. So they've got your cash, but they need to match it to the other side of the transaction. And that takes a number of days to make sure everything's reconciled and all of that sort of stuff. So you've also got credit risk. And because you have credit risk and the chance that somebody might disappear in that intervening couple of days, you also have what's known as replacement risk, because of course you'd have to do the transaction again, but with somebody else, and it would be at a different rate. So there's all of these different risks that are out there. What you have eliminated, though, in the current processes is the likelihood that you pay someone and they don't pay you back the thing that you want. You pay them dollars and you don't get back the sterling or whatever. So it's actually much safer than it was 25 years ago, which is fantastic. Resource heavy. And when I say resource heavy, it's financial resource heavy. And then on top of that, because there's all these different venues, there's an awful lot of operational processes for everyone to figure out, well, where is my money and how much have I got in this account? This is how much, like the sort of stuff you might suffer from as an individual, multiplied by orders of magnitude for these big institutions. So if you can get all of the traditional assets into a digital format, so make them digital assets basically, which is would be very helpful. You could transfer, you'd know where everything was, you could transfer it faster, and you can settle the cash leg at the same time in the same format. You'll be able to pool your financial resources and use them much more optimally, because you're using them out of effectively a single pool of liquidity. And so this has like massive implications for balance sheet usage, and only going to save the banks lots of money. And that's the fact. And the wish is that they would be able to pass some of that savings on to their customers, A, in the form of lower costs and all the rest of it, B, in the form of like a less risky system overall.
So a couple of things that you said there have sort of struck me. A lot of cost in the system, a lot of risk and so forth, a lot of which Bitcoin and cryptocurrencies be doing were we to be using their kit. The fundamental difference between but there's probably a few fundamental differences between you and them. First of all, you're focused on wholesale. Secondly, if I'm correct, you're regulated and seeking to be regulated as opposed to operating in stratosphere. You're fiat backed.
Yeah, so it's basically what we have is one-to-one with money. It is basically pounds in the UK, and it is dollars in the US, and it is in Europe. The key thing to me is I'm actually quite an enthusiast in the wider prime time of traditional markets, because the orders of magnitude are so much higher, and history has told us that you need regulation to come into that space. We've kind of seen it already with like the FTX thing and Luna and all of this sort of stuff. So there's no question that there needs to be, for people to feel safe about their money, there needs to be some sort of, it's not designed for kind of a database versus another, it's risk. So for me, for the DeFi space to get into the big time, you need to get into a regulated environment. And I think there will be a convergence, and that these guys will ultimately become regulated in some way and shift their models in some way in order for that to happen. We've just gone kind of gone regulated. We just started off regulated, but I do think there's some sort of convergence.
David, do you see a place for regulated cryptocurrencies?
So actually, just to get to my bottom line punchline for the title, will CBDC end cryptocurrencies? I'm an economist. I always have, on the one hand, the other hand, the trade-offs and the hidden risk. But for the main question, I say no. I would actually say potentially boost cryptocurrency use, because currently cryptocurrencies are often traded against stable coins that are risky, can deviate from their par value. CBDC might be a way, whether retail or wholesale, for them to be tokenized and traded on blockchains and traded against cryptocurrencies, and might actually help cryptocurrencies. It's exciting and it's great ever since the advent of Bitcoin and cryptocurrencies, as well as stable currencies, to see kind of what's possible. But in order for them to be used in the mainstream and especially the financial system, we've not just got the last 10 or more years that regulated cryptocurrencies would be key for them to be used in a widespread way to not introduce systemic risks. I think too, as well to Rom's question, I agree that I don't think cryptocurrencies will go away, but whether they will expand and ever be used kind of in large sense in the main financial system is an open question. I'm sure that I mean, it's good to have entrepreneurial spirit and see what can be done, but in order to become prime time, they need to be well regulated.
Maybe there's a little bit of, or I'm struggling with the phrasing of the question, maybe a little bit. When I think about Bitcoin and cryptocurrencies, I mean, I struggle with it, with the sort of adjectival use of currency in this context. So, I mean, I think if I can paraphrase what you just said, you think a CBDC could actually give life to the digital asset market, which could include Bitcoin and other crypto assets. Now let's focus on the question of, will CBDC give life to cryptocurrencies? In other words, currencies used as a means of payment and exchange and store of value, and all the goods and currency that sterling and dollars and other things give us, or are they likely to stimulate digital asset, as in, it could be Bitcoin, but Bitcoin as an asset, as an investment asset, or speculative investment asset, rather than as a currency?
I think yes, there is an argument whether Bitcoin and other just pure blockchain unbacked cryptocurrencies are a digital asset or a currency, a money of some sort. They have a store of value, but it's very risky, time stable, and they have a payment use, but it's just very outside of payments for other cryptocurrencies or stable. It's rare, but it's there occasionally. So I would not say they're not currencies. I think calling them digital assets is actually in some ways even more problematic, because there's an asset typically has some promise of future cash flows from it, or is backing some kind of real value, which they don't. Bitcoin cryptocurrencies are kind of in this middle space. I think really it's about what cryptocurrencies could become, and Bitcoin, when used on platforms, digital platforms that are buying and selling a lot of other kind of platform digitalized products. Is that good to your question, or you can ask? You can try again.
Well, I remain unconvinced that it's a useful means of exchange, but Rom, I mean, in your world,
I agree. It's not useful now. Whether it's in 5 years or 15 years. If you could have an economy where if a Bitcoin, or perhaps more something proof of stake or something more low cost and liquid was to be used widely in the economy by people who were accepting it and people who were paying with it, it is still a potential that it could be used. But there's just a big switch from it not being used at all, or very rarely in that, where it'll just be very speculative. If it was used widely, it could have a stable value and be widely accepted if everybody else is accepting it and it has a stable value. So you're kind of in this dichotomy.
That would be a stable.
To switch over is the big switch, but it doesn't mean it couldn't go there. I think CBDCs will enable the current use of it now more for speculation and the payments, and would actually help to head off cryptocurrencies used in a more mainstream way, because they won't be needed for digital simplicity if CBDCs are there.
Okay. Are you using stable coins, as they will be regulated, fully fungible, interchangeable with all other stable coins within any given jurisdiction? Are you thinking of Bitcoin and other cryptocurrencies becoming effectively regulated stable coins, or are you thinking of them as cryptocurrencies, as in separate, not necessarily backed, definitely not at par, and maybe not regulated? What sort of animals
Well,
currencies are you talking about?
I think it's important, right? I don't think Bitcoin, anything that is currently like Bitcoin unbacked on the blockchain, it would take a very massive hard fork for that to ever become a stable coin that's backed by anything. So I think cryptocurrencies such as Bitcoin and unbacked, should be categorized as separate, and then cryptocurrencies could also be used to talk about stable coins. I think it's more useful just to refer to stablecoins specifically and not call them cryptocurrencies, even if they're in the broader umbrella. But stablecoins specifically, as that's something that I think is much more likely to become prominent and used potentially in the economy and the financial system in the very near future. And I think that's where the main attention for regulation, if they're going to be widely used, is important.
So, Ron, from your point of view, presumably the more digital assets there are, the more digital currencies there are of different complexions, the better, because your Fnality is settling between. So were there to be a plethora of widely used things that needed to be exchanged on top of your secured credit, unsecured credit, bonds, repos, cash equities, and so forth, then the better.
Yeah. I mean, people throughout history have found all kinds of crazy things to exchange with each other and invest in. The whole NFT thing was basically about, I don't know if it's basically about, but at some point was just representing art. So it was an easy way to transact in art and so on. So yeah, I could see more and more assets transacted in that way. I was just thinking I could add something to the conversation you just had about the cryptocurrencies. For me, there's sort of different categorizations. There's stuff like Bitcoin and Ethereum that have no like they are really truly decentralized. That's a very special kind of beast. And in effect, you're investing in them. They're not really a means of payment, although they can be used for follow David's like they could be used for a means of payment, but they're not currently really a means of payment. They're kind of an investment in that network. Then it seems like there's another set of cryptocurrencies that are sort of pseudo decentralized, where there's somebody sitting at the middle controlling them all. That's much more like old private money type stuff. And for me, that easily falls into the regulatory thing, because we've had hundreds of years of people figuring out that yes, it's totally fine to have private money, but there needs to be some regulation around it. And then there's obviously things like assets, but again, that would also be very similar to stuff that already exists, and there's probably a legal framework that basically encompasses all of it. So the things that we're talking about that are truly new are very small. It's like Bitcoin and Ethereum out of all of the stuff that exists out there.
Let's turn to retail CBDC, because I think Ram's presented the case for the wholesale markets needing a private digital token in order to fiat-backed digital token in order to efficiently settle and transact, take the banking system into the 21st century properly. David, what are your thoughts on the necessity? Do we need a CBDC, I suppose, alongside this question as to what use of a CBDC in the digital context? I mean, obviously it's a digital instrument, but in particular in the retail world, why would we have it?
Yeah, it's been for some years now a perennial retail CBDC. The potential's there, but here's the solution. What's the problem? I don't think a retail CBDC is necessary, but I think it's prudent. We can look at China's recently introduced retail CBDC, and it's not well understood in terms of data and such, but anecdotally, it sounds like it's not being that highly used compared to other payment methods such as WeChat and Alipay. However, I think if you build it, will they, whether the digital pound, whether in Europe, in the US, and other countries, I think it's not clear if it will be used. I think even though if it's created and it's not used, it's prudent to have as a backup. I think the main scenario, the main reason to have a retail CBDC is because of what was seen as the opportunity, but also the when Facebook introduced Libra, then Diem in 2019. I think if Facebook had introduced Libra, say 5 or 6 years ago, before stable coins were kind of off radars, before Facebook had political and other privacy kind of loudly voiced concerns that it could have been adopted by 1 billion people overnight and become such embedded in the system that then trying to regulate it would have been more difficult. And not to say that a stable coin, whether issued by a Facebook or other entities, is a bad thing, but it should be introduced in a well-regulated environment. And if a stable coins, other payment systems for retail use become the widely adopted method for payments in a country, even under regulation, and were to displace regular bank deposit, then I think having a retail CBDC, such as the digital pound, would be very useful in case something goes wrong. I think the focus of financial stability and systemic risk management and regulation is not to say what is likely to happen and how should we regulate that. The focus, whether from earlier this year and of banking fragility or back to the global financial crisis in 2008, and the history of all crises that I've written about for hundreds of years, is not what's likely to happen and how do we manage that. You manage that through standard prudential and such, but to manage systemic risk, you need to say what could possibly go wrong, be ready, and having, instead of reacting to catastrophe in the moment and trying to build technology or provide solutions, looking ahead and being in place and ready with an alternative such as a digital pound, other widely used stable coins, even if well regulated, could go wrong, would be useful. I think there are many other potential value. Again, it's not a necessity to have, say, a digital pound or retail CBDC, but there's other many potential benefits. Financial inclusion, having more competition through other tech providers, or as the Bank of England has suggested in its consultation paper, accounts allows for potentially getting more financial inclusion reach. It's not a necessarily going to happen, but it's a potential, and it's good to allow innovation there.
Mm-hmm.
And
I want to, David. Sorry, I want to interrupt you and then come back to some of those points. Ram, I was listening to an earlier podcast you did, entrepreneurially, and the idea of not necessary but possible or prudent, as David defined the introduction of the CBDC, not necessary, a solution potentially looking for a problem, but prudent to do. You, on the other hand, described what you were doing as identifying a problem, not caring about the solution, but identifying the problem and then developing a solution around it. So where does that leave you on retail CBDC? Is it a solution looking for a problem, or is it a problem needing a solution?
I mean, David basically said that it's a solution looking for a problem, and I agree with that premise. That he was trying to explain, I believe, that there is a good reason to introduce it because it's a prudent thing to do. I guess that comes back to I guess the question I was going, does it have to be the central bank that does that? So could banks basically introduce their own form of coins, digital currency, digital tokens, or whatever that was liabilities of the bank, and use that? And that would have effectively the same properties as central bank digital currency if you had less than £80,000 in your bank account, etc. But that is effectively central bank money, right? It's all insured and so on. So if it's a prudent thing to do, that still doesn't specify how you would do it. The question I'd ask is if it's leave it to the private sector. And the reason I'd want, they will find out rationally whether there's a need, right? So nobody's going to produce it unless they figure out that there is a need that they can meet. And I have to say, as a consumer, I always struggle with, like, what would I use any kind of digital currency for as a consumer? If I need to go get a cup of coffee, I can do that in an incredibly easy way with my my phone and through the card network and all the rest of it. So I sort of struggle to see in the developed world what the use for it is. I can totally see in developing world you might want to you might not trust your central bank or your government, so you want to use somebody else's money. That all makes sense. But I really struggle to see the usage in the developed world. I think some people would argue, well, there's these stable coins and they're doing incredibly well, and that's kind of retail. But they're a very special type of instrument as far as I can make out. They're really designed to take the friction out of trading crypto assets and all the rest of it, and for you to be able to hold your money and probably avoid tax because you haven't taken it out of crypto assets for some period of time. So I'm
You're skeptical.
Yeah, I'm skeptical as well. Yeah.
Well, I mean, there were people, myself included, who struggled to think of a use for a mobile phone, let alone whether the use of paying with a mobile phone. So I think that there is also you introduce it and it will get used.
Well, let's take the mobile phone. So the mobile phone had a very specific use case. It was really designed for business people operating outside of the office so they could extend their office hours. So basically traveling sales guys. And if you remember, the first ones, this is why there's Carphone Warehouse in the UK. The first ones were like the size of like a small suitcase, and you had to put them in the trunk of your car. There was a definitive use case and a need and a set of people that were willing to pay the money for those things. So this is not the same as that, I would say.
Okay. Well, then let me go to three things that I think could be reasons. And David, you touched on, and I think two of them. Who deals with financial inclusion? Who deals with competition in the future and fungibility in the future if it's private monies private digital currencies we're talking about? So how do you ensure fungibility between the JP Morgan coin and I don't know who the latest is to introduce a coin? That's number one. And if we don't, is that a good outcome for domestic markets to be splintered in currency in effect? Who's going to ensure that there's financial inclusion, as in the poorest, oldest, and most infirm can transact digitally, can exchange fiat value if there isn't a skill that they can? And who's going to deal with competition in this digital world in which everything is transacted digitally and the central bank doesn't have competition powers?
So for fungibility, I think one point that's not been pointed out clearly enough is the potential issue, and as we've seen recently and ongoing, of fungibility in terms of stable coins, as we've seen currently and as maybe be going forward, is that they're both, if they're backed and they're redeemable, then this sounds like what a typical bank deposit current account, say money market fund account that has same-day payments does. However, they're also tradable. And this is more like an ETF versus a mutual fund that you redeem. An ETF you can trade. These are both great properties. You want it, redeemable is useful. Tradable is also useful. But there's an inherent conflict. As soon as these are tradable and redeemable, then tradable means that there's the potential to, sell them, whether borrowing to sell or whatnot, and there can be speculative tax, and so to destabilize, make them less fungible, and more clearly, whenever they're trading and not at par value, then this is pushing away from fungibility. And this is a very basic financial economics problem. Well before stable coins were ever introduced, about the friction there. And so I think, again, this is a reason why there might be decent solutions for stable coins used in the future that are, well backed and well regulated. But if they're tradable, this is a question of a friction that could come up and, say, in my scenario, even if well established in a crisis time, really become, unhinged. And if these are much more widely used, could spur a crisis, shutdown of retail payments in the system. And instead of saying having paper currency is in diminished use as the backup, then this idea of having, the prudent central bank's retail CBDC as the backup, I think is just an explanation. And again, so going to Jerome's question about the private sector, it's always good to have private sector solutions in place and to encourage. And the central bank has a monopoly on base money, but shouldn't try to monopolize payment systems and digital infrastructure. Having that outside innovation is what spurs better product. But ultimate prudence does come from the central bank as the backstop. And in wider and wholesale payments and liquidity and lending, the global financial crisis of 2008 showed there wasn't a lot of forethought to a modern global, developed country financial crisis. But because of that, a lot of tools and lessons were developed and in place from the start of this year, not having banking problems develop into an actual crisis. Okay, so
David, you're doing very well not answering my question, so I'm going to ask you a different question.
Fungibility. I would like to address.
Okay, but can okay, this is related to fungibility.
Third question.
Well, sort of. But can we think? Let's think about the interchangeability of sterling today. I've got money in Barclays. You've got money in NatWest. Rom's got it in Monzo or somewhere. We can all move our money instantly between our banks, thanks to a huge and very expensive range of infrastructures that sit behind in greater ropiness or not. Who's going to provide the digital infrastructure that connects the private stablecoins if it's not the private sector, if it's not the public sector? The fact that my JP Morgan pound is still worth a pound, that's great. It means that I can exchange my JP Morgan coin for a JP Morgan pound and then send my JP Morgan pound to Barclays in the instant. But that's not additive to my life. What will be additive to my life, if we're going to have stablecoin usage, would be to send my JP Morgan coin to become your Barclays coin, presumably. But if you don't have an infrastructure sitting behind that, how do we make that happen? Or are we just going to have these private coins sitting on the old infrastructure?
I think they won't be highly used if they don't have exchangeability with each other. Mm-hmm. My point was for fungibility. The first thing you need is that they have a very stable value. And once they're tradable, then all this, even if you have the infrastructure in place, well, once your bank's stable coin is actually trading below par, my bank and my bank's infrastructure might, even if the infrastructure can be developed and by the private sector and can be guided and regulated. But even if it's in place, as soon as the, just the par value goes away, that's, I think, the biggest threat to the fungibility. I think the infrastructure can be developed and it should be regulated, but it doesn't have to be a purely public infrastructure.
Yeah, I agree with that. I mean, basically, there is a regime for doing this called the basically financial micro infrastructure, and it would be a payment system pretty much like we're doing. In the UK, I don't think, I think faster payments and BACS used to be private payment systems, but they're no longer. In the US and in Europe, there are definitely still existing private payment systems for retail that move money very quickly between each of the different systems. So in the States, there's RTP, which is real-time payments that moves money between JP and Citibank. And in Europe, there's something called RT1, real-time one, I guess, that moves money very quickly between, I don't know, Deutsche Bank and Commerzbank. So there is definitely I guess my point is there's definitely a regulatory framework to allow whatever the infrastructure, and so somebody needs to see that it's profitable enough to build it. And then, yeah.
Of course, there wouldn't be that common interest to begin with. There'd be a selfish interest in developing the stable coins, and then a public problem
exactly
to make them all be fungible, and interchangeable. And that's slightly I guess that's where my question is coming from. You don't know something's important or systemic until it is, and then you can't be building the infrastructure afterwards.
Yeah, I agree with that. I mean, in a funny sort of way, the system that I'm building, the Fnality system, is actually that system. It's just that we're not aimed at solving a retail market problem. We're aimed at solving effectively a capital markets problem. But there may be underneath all of that, really, Well, no, I'm just saying there may be underneath that, kind of an agglomeration of retail payments that have to get paid in a big lump, somehow.
So, David, sorry, I'm coming back to you. Can you answer me on inclusion? So what do I do as a central bank? I need to make sure that everybody in my jurisdiction can move my value, can hold and move my value. And now the future is completely digital, possibly in the hands of, let's say, a duopoly, because we're quite close to that. So how do I make sure that everybody can access?
I think there's two aspects of financial inclusion. And one that you're pointing at is, okay, once we're in a kind of world, if I have a digital pound, how do I make sure people are included? The second aspect that I think is more immediate, I think that will be some years off, is there are a lot of people who are unbanked, services for holding money digitally, and so rely more on either currency cash or on perhaps not the best digital payment systems. And so I think that's actually one question that actually the digital pound is looking to address, not just in the future, but how do we catch people up to today? And so I think that's where a digital pound can be helpful, because it allows new competitors of tech companies or others to be payment and interface providers, as is the current suggestion. Nothing's decided. And so this can potentially allow for competition, innovation. There's a lot of issues, and questions about what the lack of financial inclusion is. In the US, which is not as much of a problem in the UK and Europe, bank overdraft charges, hidden fees, and actually just the slow payments can make it very costly in surprising ways and keeps people out of the banking system. The UK is already doing better on that. But whether it comes to convenience, the timeliness of getting your paycheck, or if you're getting paid in cash, getting that into your account and being able to use it, I think the competition is the best way to spur, and I think a digital pound and allowing others to compete is the best way to spur this. Ultimately, it's more of a legislature question to decide how much to actually try to require or take more hard measures for financial inclusion. I think that's ultimately has to be a question the country really says, what is the restrictions or the requirements in order to get certain segments that are not included, and to look out for them.
Yeah, actually, maybe I can add something as well. I don't know what all the dimensions are that cause financial inclusion. So, but there's one big one that I always think of, because I used to work in a bank, and it is all the stuff around anti-financial crime, in almost a relative term, but it's costly to carry out all of that stuff. And that therefore precludes, as they currently are, from accepting certain clients, because they're not going to make sufficient money out of them, or they can't be sure that they're going to make money out of them, or whatever, or they don't pass even the test because they just don't have enough of a track record and all the rest of it. I can't see that situation changing, even in a digital world, with I'm going to call them a fancy tech company, although I run a fancy tech company, but with a fancy, I can't see how that's going to change, because that's like a society wants all of that, via the government regulation, etc., has basically demanded that we do all of that kind of anti-financial crime checking and stuff. And people, these institutions that issue the money are going to have to be liable for whether people have done it. And if they're not really making any money, which is kind of part of who's going to pay for all of that stuff? So it's a very small part of the financial inclusion thing, but I think it's an important one.
I think you're right. I mean, I think the newly arrived immigrant with mortgage statement and utilities bills and so forth finds it very difficult to get a bank account, and that's for some sort of unprotected e-money instrument, and maybe puts up with that for a long time because he or she doesn't know about the alternatives, or still doesn't have a utility bill with which to open a bank account. But maybe we can live in hope that in the digital age there will be improved ourselves than an old bank statement. I realise we've only got about 7 minutes left, and what I thought would be good to explain. Clearly, these areas are hugely exciting. Ron, what you're doing is very exciting. What is or isn't happening in the world of digital assets, cryptocurrencies, CBDCs. Personally, I think a lot of these questions are still up in the air. But if I was a young student, cast my mind back, what would I usefully be studying? What would I be thinking about? What would make me useful to industry? What are the subject areas that I would focus on? Who should I be listening to, watching? What should I be doing? And I'm going to start with you, Ron.
Well, so I've got two not particularly young sons. So one's 22 and one's 25. So one of them is a mathematician. The one that's a computer scientist actually is a professional gamer. So I don't know what you want to make of my advice to young people. The other one's looking for a job in data, etc. I mean, for me, actually the world's really shifting to a place where David's not going to like hearing this, where some aspects of the world don't really need a degree in the way that they used to. So if you want to become a software developer, for example, actually the best thing for you to do is get on with software developing, put your stuff on GitHub and build a community around yourself, and then you'll get picked up. And you think about all these entrepreneurs in the States that end up dropping out of university because it's not really serving their purpose. I've got to tell you, since I've been working on this whole money thing for the last like 7 or 8 years, I actually think the thing that's most valuable is actually thinking about philosophy and science, society and all of that sort of stuff. Because actually, this problem is a problem of how do people connect in some way, and how do so for me, there's actually something in the humanities that is pretty important to understand. I should put all of that with a disclaimer of like, I'm just like some dude, so I don't know what I'm talking about. Maybe you shouldn't follow my advice, but that's my current thinking is are degrees really that important anymore? Unless you're doing something like being a doctor or a lawyer where you just have to have one. But in general, are they really that important anymore? And actually, is the humanities slightly underrated because a lot of the stuff is about connecting, connecting humans and all of this sort of stuff.
Well, yes. But is it, David, maybe as I come to you, is it not so much that we put education into question per se? Obviously, in the context of a Warwick Business School podcast, we don't want to put that too much into question. But is it more a question of reassessing the mix instead of looking pure science, pure maths, pure technology? That when we're thinking about questions like this, actually what we need is a mix, whether it's coders, humanists, economists, mathematicians. What would you advise them?
I think one of the big challenges that's been in place for some years and going forward is when it comes to financial services, banking, financial markets, and then the technology and the fintech is even currently in place now at banks. There's a large divide between those who are the tech people and those who understand the economics and the finance of the banking and the payments. And so I think, just a plug for, the business school, studying and a degree. And I agree. I think humanities and just understanding humanities and social sciences more broadly is critical. We see AI rising, and it's a question of, I think, learning coding, having a math background is very useful. But these are skills that we're already seeing impact just practical coding jobs, right? I think the most important thing is learning how to think and learning kind of the deep knowledge of the economics and the finance along with the technology to really not just, what's your job going to be? Any career is going to lead to a leadership management path, as well as trying to be innovative in the near term. So having that, the training, the background, thinking about what your career is for the next 5, 10, 20, 30 years.
And learning how to...
Actually, can I just add to that? Because as you were talking, I was realizing there's something which is actually, I think you're completely right. This whole thing about fintech, the reason the words are joined is because people are very fin to be done by some tech folks. And the issue is actually that there isn't a connect about how people and its implications, and then some sort of strategy. So it's not some joined up thinking. And that's quite hard for people to do, given quite siloed sort of. That is a very strong argument for multidisciplinary stuff, kind of contextual areas.
So there we go. Generalist thinkers, I think, have a future. I come away with that. I didn't hear the word ethics come through, but I'm sure ethics. But with that, thank you very much for listening. It was brought to you by the Gillmore Centre for Financial Technology at Warwick Business School, and there's more to come from here. Thank you very much, Rom. Thank you, David. I hope to have you both back again. I'll be back next week, or soon anyway, bringing you another episode exploring the big issues and be kept up to date with the latest research, thinking and issues in fintech. Be sure to sign up to the Core Insights newsletter, which will deliver all the analysis you need direct into your inbox. A link will be in this episode's notes, output from both David and Rom, and more reading on this subject. And finally, please subscribe to the Core Insights podcast so you don't miss the next episode in this fascinating fintech series with Warwick Business School's Gillmore Centre for Financial Technology. Thank you.